losing your valuables can bring a lot of anxiety and trouble, especially if it's the money that you've lost in an investment. The distress is real. If you have by any chance experienced a certain loss in your investment, you definitely deserve to know what went wrong. A number of factors can play a key role in bringing down your assets. Losses are an essential part of investment and business. These losses can be subtle in form, occurring at a slow pace, or they can be immediate in effect, causing much harm to your financial assets in a short period of time. In today's video, we'll be discussing how we can recover lost funds that happened to the failed investment or so. Among all type of investments, a loss in the stock market is carried out by a number of factors. To mitigate such a loss, it's important to comprehend the reasons that weighed down your money portfolio in the first place. Investors refer to losing money in the stock market as a drawdown. A drawdown is simply an account that has less money than there was in it before. A significant loss in a stock investor's portfolio can lead to even more losses in a gradual manner. Unexpected losses can be harder to endure. They can sometimes be the cause of poor decisions and in return lead to irrational reactions as well. To mitigate these losses, the stock investor can rush into making quick decisions in order to avoid making any further losses. In doing so, the investor becomes vulnerable in making more poor decisions that ultimately lead to bankruptcy. Analyzing the stocks over 2 decades, Robert Johnson, professor of finance at Creighton University, remarked that over 20 years of period from January 2001 to December 2020, if you missed the top 10 days of stock market performance, you've missed almost 50% of your returns. The annualized returns of those who missed the top 10 days by selling their profit had a cut from 7.47% to 3.35% per annum based on their poor judgment of the market performance. In other words, taking uncalculated decisions can make you lose a considerable portion of your returns eventually. Therefore, it's pertinent to analyze the associated factors causing losses in investment and take measures to recover financial assets. Today, I'll be sharing with you 6 tips that you can apply accordingly and that may help you recover your losses. Make sure you watch the video till the end so that you don't miss any important points along the way. The first tip to recover a loss in investment is to avoid taking prompt decisions. Risk management is the most important strategy that you need to focus upon as an investor. In the stock market, it often happens that after an investor suffers from a loss, he or she neglects risk management strategies entirely. If you do that, you'd be prone to taking more risks that could generate more losses in the meantime. Hustle in taking decisions to make a quick recovery can potentially cloud your judgment, leading you towards a financial disaster. The all-or-nothing approach can be the basic source of putting your finances at further risk. Calculated moves are necessary to avoid multiplying your losses. Barbara Stewart, in her research paper, shares a success story of Jessica Wu in her investments in the stock market. Wu, in her interview, told that she had a return by almost 264% since early 2020. Her rational decisions and passion to learn asset management brought her fortunes from the stocks. Reevaluating your investment choices is the second suggestion for you on our list. If you have a loss percentage of 50% or even more, it's probably linked with your investment choices. You might want to look for some less risky adventures instead. More diversified investment portfolio might save you from bigger losses in the long run. In other words, don't take chances in your investments. Instead, look for calculated investments that can minimize the risks. Buying stocks from different companies, keeping in mind diversified portfolio, can stabilize your shares. A loss in one of the shares would most likely not be affecting your other shares this way. For example, buying shares of Apple along with Bitcoin and several other funds as well can lower the risks for you to a great extent. The third tip in this regard is to make a difficult yet wise decision. You might have heard that you don't lose until you sell. However, it's sometimes wise to cut your losses earlier to ensure stability in your long-term financial investments. At times, you don't need to make a recovery from the point that you had suffered a loss in your investment. For instance, let's say you have $1,000 left after a loss. Rather than surrendering to more vulnerability in your stocks, you can invest this money in someplace else that can ensure you profits with lesser risks associated. It might happen that you buy a stock and its value goes down subsequently. This kind of loss is rather painful to bear as it works slowly and that too in a deadly manner. If that happens, you decide to sell the stocks at a lower price. This loss is referred to by stock investors as capital loss. In a capital loss, the selling price of a stock is less than the price in which it was bought. A capital loss can be used to offset a capital gain in which profit is gained by selling a capital asset for tax purposes. The capital gain or loss is short-term if stocks are kept for a year or less. Similarly, they can be long-term if the stocks are kept for more than a year. In case that happens, you should simply move on if you've lost confidence in your investment. However, as Anessa Kustovich, Chief Executive Officer at Cardinal Retirement Planning, states, if you sell your losses when the market is down, you'll find it extremely hard to make up for those losses. The biggest gains come shortly after corrections or big losses in the market, and it's extremely difficult to time these big gains, so it's safest to stay invested rather than miss out. In this regard, it's clear that you shouldn't chase one stock after another if you continue to bear losses. Learning from your decisions is vital in stock market investments. The fourth suggestion in the process of loss recovery on our list is to analyze your portfolio in a thorough manner. You cannot manage your portfolio if you don't analyze it on a regular basis. In order to make your investment grow, you need to be sure that it goes in the right direction and not the otherwise. Especially those who invest in different stocks at a time, it's important to keep an eye on your investment portfolio in order to be sure that it's delivering you the desired results. In case you're experiencing losses in your large holding stocks and you fail to manage them, results can be worrisome in the long run. By regularly analyzing your portfolio, you can make the necessary changes in time and save yourself from significant losses. This way, you can minimize the risks of loss along with making timely and quick recovery from any previous losses that you've made. Analyzing your portfolio is an important risk management technique that must be followed by you as a stock market investor. Moreover, by taking these timely measures, you can make a desirable number of returns in the safe and easy ways over the course of time. The fifth suggestion in order to overcome a loss is not to let that loss define you. Remember that stock market is all about losses and profits at the same time. Many other people like you would have had a loss in their investment, and their loss might be heavier than yours. So making a loss shouldn't cloud your judgment. Taking loss personally can harm you more in the future. For instance, often people see a loss in their investment by buying volatile stocks. This happens when a stock goes up in a short time and then suddenly makes a retreat. Many people sell their shares when the volatile stock is retreated without waiting for another chance of profit. Suppose that happens and you take that loss to your heart. Your decision of selling your shares might cloud your judgment in the future. The next time you invest in a stock, you might decide to hold on until the stocks go up again, which might not happen. Putting it simply, you should never let a loss dictate your better judgment. In fact, analyze the situation and decide accordingly in order to avoid any loss in your investment. Singer Bishattaraya shares her success story in stock market, stating that this market has been a wild ride. I've made lots of money in a short period of time on stocks like Volvo, PowerCell, Arise, Beyond Meat, and Bambuser. In just a few weeks, I made 30% on Volvo and 50% on Bambuser, a Swedish startup working with live video sharing technology, and doubled up on my EPR property stocks. My portfolio is up over 60%. I realize it's not a regular market we're dealing with. The market is a fickle lover. To sum up her experience, consistency is the prerequisite in stock market. Last but not least, our sixth suggestion for you is reevaluating your previous decisions to avoid any further losses in the market. It sometimes may happen that you invest in a stock and a year later it stands close to what you had paid a year before. In other words, it hasn't shown any growth in the meantime. Although hard to comprehend, it's a genuine loss in your investment. The reason is that keeping your assets in the market, say $1,000, didn't bring you any returns in 1 year. Had you put those $1,000 in someplace else, you might have drawn a profit out of them. Stock investors refer to this as opportunity loss, meaning that you've lost an opportunity to make gains. This happens when a stock remains stagnant for a certain period of time. If that happens to you, all you need to do is reevaluate your choices for the future. What needed to be done differently? What additional measures did you need to take? Ask yourself these questions and you'll most probably find yourself in a better position than before. To conclude, there's no magic wand in stock market that can save you from all those potential losses lurking in there. You can't learn market strategies overnight. Rather, train yourself by learning from the ill choices that you've made in the past. play on the safe side by investing in individual stocks at the same time. Take measures to reduce the risks. Pay attention to the global events that might cause disruption in the market. Analyze your portfolio keenly in order to mitigate any loss in a timely manner. Most important of all, don't let greed overcome your decisions. Invest in a smart and calculated way. No one can predict the market in an accurate manner. Learning from your mistakes and making safe moves are the key to making huge returns out of your investment. Thank you all for watching. Hope you enjoyed it, and if you did, do let us know by smashing that like button, and don't forget to subscribe and share this video with your loved ones. See you then!